Our deepest sympathies go out to everybody who has attempted to purchase a property in the previous 2 years. Yes, depending on whether you're trying to purchase a property or sell one, the American real estate market has traditionally been either hellish or not. Almost all housing statistics you can think of have broken records in the last year. Home prices reached a record high. The proportion of properties that sold above asking did as well, and there were record few homes on the market. So, what to expect? What is a property chain? A group of home buyers and sellers who are connected as a result of purchasing or selling a home from one of the other members of the chain is referred to as a property chain. A person who is simply purchasing a property at the beginning of the chain, as opposed to selling one, can be a first-time buyer just starting in the housing market. A person who is just selling a home, not buying one, such as someone who is moving into a rental property, entering a retirement community, no longer needs their home, or has passed away, will be at the end of the chain. The links of the chain are made up of everyone who is in between the beginning and the end. Issues in the chain. It's possible for someone at the beginning of the chain to decide they no longer wish to sell their home. This has an impact on their buyer, who could be unable to move out of their current residence until they found a replacement home. This in turn affects other buyers and sellers farther down the supply chain. Financial issues are another factor in chain failure. For instance, if a property is not accepted by the mortgage provider, a person may not receive the mortgage they had anticipated. Once more, this results in delays and chain failures. Property chain failures are also caused by gesundering and gesumping. Gesumping occurs when a seller accepts one offer and then accepts a second or better offer from a different buyer at the last minute. Housing chain collapse of 2008. The enormous expansion of the subprime mortgage market, which started in 1999, was the cause of the 2008 stock market and housing crash. Home loans were made available to customers with bad credit scores and a higher chance of loan default thanks to the government-sponsored mortgage companies Fannie Mae and Freddie Mac in the United States. These borrowers, dubbed subprime borrowers, were able to obtain adjustable rate mortgages with small monthly payments that gradually increased in size over time. Because they owe more on their mortgage than the value of their homes, homeowners were in a negative equity situation and were unable to simply flip their way out of their homes if they were unable to make the new higher payments. Instead, they experienced home foreclosure and frequently declared bankruptcy as a result. Financial institutions offered mortgage-backed securities, or MBS, or pools of these subprime loans to significant commercial investors. Borrowers began defaulting on subprime mortgages in large numbers by the fall of 2008, which resulted in financial market volatility, the crash of the stock market, and the subsequent worldwide Great Recession. What is happening right now? The mortgage rate and house pricing. At the beginning of 2022, the mortgage rate was 3.25%. It then increased to 5.55%, and in July 2022, it reached 6.27%. The growth was due to the global epidemic and its impacts. Mortgages were less common, but after the outbreak, mortgage prices rose to a record level. A $400,000 property in the U.S. had a $1,399 mortgage at the beginning of January. It is now $1,976. A 29% down payment is needed for a property similar to that. Not to add that during the past few years, the house's price has increased dramatically. Homes now cost over 20 times more than they used to. According to the National Association of Realtors, home sales declined for 6 consecutive months in 2022. Interest rates and the housing market. Interest rates in the U.S. are rising every month. In the previous year, the interest rates for a 15-year fixed mortgage and a 30-year fixed mortgage were, respectively, 2.3% and 3%. Interest rates are currently 4.8% and 5.7%, respectively, as of 2022. This is not the end. The federal government will decide to increase interest rates at the end of the year. Consequently, it is expected that home sales will decrease. Because of the ongoing inflation, some are concerned that they won't be able to afford the high interest rates. Supply and demand for housing. The Federal Reserve economic data keeps an eye on the housing supply in the U.S. In a thriving market, it should take 6 months to sell every house. Home supply and demand are currently out of balance. Demand is higher and there are fewer properties for sale. 30-somethings make up 31% of home purchases. Gen Z is currently falling behind millennials in the housing market. Homes on the market will be in high demand in the following years. The problem is with the supply chain. In the previous year, not enough homes were constructed and the cost of available homes is too high. The price of building supplies on the market has increased and there's been a delay in supply. Together, these factors have resulted in higher prices and fewer property sales. Despite the efforts of the American government, there is still time for the housing problem to be resolved. Increase in foreclosures. Since the outbreak, the market's foreclosure rate has fallen to 30%, and more people than before are losing their homes to the bank. A government restriction on foreclosures during the pandemic was one of the reasons behind that. The bank's alternatives were so constrained, but as soon as the prohibition was lifted, they got to work. This is bad news for homeowners whose income is unstable because they will be looking for other houses on the market. For home buyers, it might be the best moment to buy a foreclosure right now. More foreclosures could increase the supply of properties, but make more people homeless. The global situation in housing. The American economy has been harmed by the prolonged war between Russia and Ukraine. The ban on Russian oil has led to an increase in the cost of energy and other goods. Monthly inflation is rising. The results of this are high interest rates and high house prices. Currently, people are worried about their daily expenses and how the conflict may affect their lives in the United States. Many people no longer have any interest in the housing market. According to research, customer confidence fell to a 10-year low in March of 2022. The Federal Reserve is seeking to lower borrowing rates for individuals in this situation to drive down prices and increase interest in real estate. This suggestion, however, has not yet been put into action. What to expect in 2022. There are no breaks in the trend when it comes to property prices. Rent and mortgage rates were higher at the start of the year. Home sales in May 2022 are down 8.6% from April 2022 and 3.4% from May of 2021 due to price increases. If home prices continue to rise, data and analytical specialists anticipate that the real estate market will undoubtedly overshoot. Is a housing crash worse than 2008? According to Redfin's report at the end of May, nearly 1 in 5 buyers reduced their asking price, an occurrence that hadn't occurred since October 2019. The actual cost of buying a home has climbed by about 50% in only the last 6 months, and mortgage rates have already jumped by more than 6%. This has been the highest mortgage rate since 2008. The 3.2% point increase in mortgage rates over the prior year is also to blame for the biggest production fluctuation since 1981. A lot of prospective borrowers who couldn't meet the bank's mandated debt-to-income ratios are no longer eligible for loans as a result of the constant mortgage rates, while buyers who were underestimated would only have to pay extra. For a few more months, we won't be able to completely comprehend how much demand is anticipated to fall over the upcoming few months. And things could get extremely bad if the Fed increases interest rates another time to above 2% by the beginning of 2023, as some experts forecast. Of course, the crash won't happen according to some analysts, and we genuinely hope that's the case. Analysts predict that the typical third-year fixed mortgage rate will rise from 3.1% to 3.3% by the end of the year. We can't predict with accuracy what will happen over the next 12 months because there are so many factors influencing the Fed's policy. Though we are certain that the U.S. will not be easily able to overcome this housing chain crash, as many people are struggling to put food on the table. This ends the video for today. Share your thoughts in the comments. Like, share, and subscribe to the channel to learn more. See you in the next video.